Good afternoon, everyone. It's a pleasure being here to take part in this Congress, part of this roundtable with friends, despite virtually, and we hope that the scenario can change and we'll be face to face to celebrate. That's the best part of the forum, normally celebrate. But anyway, having a forum that's so successful since Wednesday, so I put my remarks, and it's a pleasure being chair of this panel. And so we take part in forums tax. So the subject of this part is tax implications on non-tax compliance. So we have here the persons Betina, Grupenmacher, Pedro, Schoueri, Marcos, Livio, Liselott, Kana, Paulo, Caliendo, and Gustavo, Vettori. The CVs will be presented.
OECD also taxing on digital services, investigating if the potential conflict with non-discrimination rules of OMC. And this table, we have the moderator, Pedro Schoueri, who will conduct the second part of our panel, the second round for debates, especially regarding the practical side we have to face. So I will start the panel, passing the floor Professor Liselott Kana, so you can start. Thank you very much. And once again, I record my thanks for the invitation made.
Thank you very much, Professor Grupenmacher, and thank you very much to the organizer of this event. Very happy to participate in this distinguished panel. And the only thing I'm sorry about that I have to do it from home and I can't join you in Sao Paulo. So thank you very much again, and I look forward very much to talk to our colleagues today. So my role at the beginning of this panel is to sort of introduce a little bit of the issues of this point of tax treaties and non-tax treaties, and what the difference of treating different disputes in one area together with the other. So there are going to be panelists who are going to enter a little bit more of detail. And the idea of having this introduction is to basically have a sort of level playing field between all participants, because probably some colleagues are very well versed in this area, and others perhaps just a sort of interest. So the point here now, and what I'm going to try to do, is just to make a sort of an overview of what are the issues here. Well, first of all, tax treaties, as most of you know, don't normally, at least in our part of the world, don't deal with arbitration. And many of the treaties that we're going to look at today actually have mandatory arbitration. So this is one of the issues of where a taxpayer or an administration have to face perhaps an arbitration. And that's why in the recent years, this has come up more and more. So when I say, there's two issues, and I think the most important one is what I said, is the arbitration possibility, but also these treaties can affect national rules. And that's, of course, also important for policy reasons to evaluate. So if we go on, Pedro, and we can have a look at one of the first important treaties that, in fact, at least from a Chilean point of view, we have a lot of bilateral investment treaties. We started to negotiate in 1990s quite a lot of these international bilateral investment treaties, basically for the purpose of protecting and dealing properly with foreign investment, promoting foreign investment into our country. I have the feeling, and it would be interesting to hear from my colleagues on the panel, but I have the feeling that Brazil did not take the route to sign as many bilateral investment treaties as Chile did. But in the region, we have quite a lot of bilateral investment treaties going on. Some have actually been started to be denounced. I think Ecuador has denounced a couple of bilateral investment treaties, and that might be something that will come up in the future, depending on how these treaties are used. Most of them have a minimum time frame. That's quite interesting. You know, the treaty normally can be, you know, denounced or put out of order within a year. You know, the tax treaties, sometimes they have a 5-year period, some period, longer than 5 years. I have never seen a tax treaty. But in the bilateral investment treaties, some of them actually have 15 to 20 years minimum level of application. So even if you say, if you denounce a bilateral investment treaty, you might have to wait 20 years before that comes into effect. So what do the bilateral investment treaties do? Well, first of all, and the important thing is expropriation. They prohibit expropriation unless there is a fair and equitable payment for that expropriation. Now, of course, expropriation and tax, I would probably think that some people even say taxes are expropriation. So I think that there we started off with a problem. Taxes and expropriation, of course, is where do you draw the line, basically, of a proper indirect expropriation, direct expropriation, and taxation. Also, we come across other rules like national treatment, most favored nation treatment, and fair and equitable treatment. Those are treatments that are in international law, in commerce, used basically to give an investor that goes into your country the right to be treated in the same way and not be discriminated against. Now, again, you know, withholding taxes per se are, of course, discriminatory against national treatment. They are completely against national treatment. So what you should have in these treaties is basically exceptions. Most of them don't have it, but the scope of it is quite gray, and this is where I think we might have a problem, and why this is becoming more and more sort of a hot potato. And what is important here, of course, is what I started off with saying, is that in these cases you have arbitration. If you have a dispute on national treatment, on expropriation in these bilateral investment treaties, you have right to go to arbitration. And that arbitration is usually in it's different in different treaties, but in the case of Chilean treaties, at least, it's the ICSID, it's International Center for Dispute Settlements in Washington, but depending on the treaty. So if we go on, Pedro, and as I said, some of the older bits usually do not have these exceptions. Some of the newest ones have it. I would I don't have time today to go into any details of treaties, cases, but I would like to mention here two important ones, Vodafone and Lone Star. Vodafone, probably we all know about Vodafone, but the origin of it is the bilateral investment treaties, or the arbitration part of it, of course, is the UK, India, and the Netherlands, India bilateral investment treaty. That's the origin of the arbitration dispute. The origin dispute is capital gains that India applied to Vodafone. And Lone Star is similar. It deals with capital gains again, selling of a bank in this case. And this is the case where the arbitration is related to the Belgium-Korea tax treaty and the Belgium-Korea investment treaty. These are old cases. I mean, they go on for ages, like 20 years. I think at least Lone Star started in 2003. And the latest I've seen on Lone Star is that they're going to get an out-of-court settlement. That's what I read this year. The other thing which is interesting is, as well, when you deal with these cases, is it's very difficult to get information on the settlements and the cases, because ICSID allows for its rulings to be secret. So if we are going, we're not going to get any lot of information out of ICSID when we have these cases. So to have a sort of interpretation or jurisprudence on these arbitration cases of taxation is not going to be possible. So if we carry on, Pedro. Now the next big group of treaties are the trade treaties. And the interesting thing here is, I think, is that as of 94, when NAFTA came into force, what the trade agreements started to do, the sort of modern one, they call the modern trade treaties, they took the BITs, the bilateral investment treaties, added them to a free trade agreement with goods and added services to it. So you have nowadays in these modern, so-called modern trade treaties, you have investment services, intellectual property sometimes, and goods. So you really come up with the same issues as in the bilateral investment treaties. As far as I understand, the origin of the NAFTA treaty in 94 was the bilateral investment treaty between Canada and the US. So basically they took a bilateral investment treaty, put it together with services and added goods to it. Now, of course, NAFTA is an old treaty, and today we have an updated version of the TPP. The TPP today was signed, well, probably you know the story, the US withdrew when President Trump came in. He withdrew from the agreement, and now it was signed. It's called TPP 11 now. It was signed by the other negotiators, but the only two who has ratified it yet is Japan and New Zealand. So it's not going to be enter into force that quickly. Now, I put up on this slide that with global difficulties, perhaps regionals are going to be more active. I have the feeling that today very little on this area is going to happen. So we're going to be stuck a little bit with the old rules. So just have a look at the next slide, Pedro, and what we'll see here is the rule, the exception in the NAFTA agreement, which is, at least in Chile, it's the treaty that we have with the US and Mexico. And I suppose that many of our neighbors have. I don't think Brazil is part of any of these treaties where you have this type of exceptions and trade agreement. But many of our bilateral trade agreements today are so-called modern trade agreements with investment and services. And in this case, we have this type of solution and exceptions. Because of what I said earlier on national treatment and expropriation in particular, we need to have an article in these treaties that deals with taxation. And we usually do that through the exceptions chapter in these huge trade agreements. And the only thing that I'm trying to say with this slide is that it's very, very complex. Just like, this is what I picked up from Article 2103 in the NAFTA agreement. It's called taxation, and it starts off, except as, then it starts in the second paragraph saying, nothing in this agreement, so except as what comes after this, nothing is dealt with in taxation. Then it says nothing in this agreement, and then it says notwithstanding. In other words, it tries to carve in things, and then it says subject to. So you can see that there's a labyrinth of different type of taxes, and basically the history behind it is that the NAFTA was negotiated 1994-95, and WTO was negotiated at the same time. So what the negotiators tried to do was to be sort of inspired by the latest in the WTO negotiations, which was going on at the same time. So you can see that they carve in some of the indirect taxes, they carve out direct taxes, and then they carve in expropriation. So if you go to the next slide, this is the case that I have found. It's the only case I find on NAFTA. It's a Canadian case. It's the Gottlieb Investors Group case. And what happened here was that the Canadian legislation was changed. They had a special provision in its legislation giving special benefits to invest in certain energy trusts. And Canada changed that legislation, and Gottlieb investors were not happy. So next slide, Pedro. This is just very quickly to have a look at the legislation and what the Gottliebs tried to do. They said that this is an indirect tax expropriation. And what they did, if you have a look at this article, what the Gottlieb investors had to do, they had to give a notice of intent to go to arbitration. And unless both tax administrations agreed that this was not an expropriation, Gottlieb investors could go to arbitration. And this case, so in order to comply with Article 1110, Gottlieb investors gave notice that they wanted to go to arbitration, and the Canadian government, the Canadian tax administration, sent a letter to the US tax administration saying that we don't think that this is an expropriation. And 3 days before the 6-month time limit period that established in this article, the U.S. tax administration responded, and it was an agreement with the Canada, and this was never taken to any arbitration. It just shows as an example of what is the procedure that you can actually do under this NAFTA agreement. So let's quickly move on. Other speciality areas are the maritime and air transport agreements, and also the very, very important Energy Charter Treaty. The Energy Charter Treaty is also around the same time, 94. I think it came into force 98. Today it has 53 signatories. It's a bilateral investment treaty, but trying to promote energy sector within a region and basically within Europe. So it's a bilateral investment treaty, but particular notice to energy sector. And there is basically here as well a prohibition for expropriation. So let's carry on, Pedro. This important case that I mentioned is the UCOS case, yeah, and here what the arbitration came up with. The case is this huge Russian oil company. What the Russian government did was they assessed it tax-wise with extremely high taxes, and they basically bankrupted. So what the owners wanted to address here in its claim in arbitration was that they had been expropriated. The court went on their side, and they actually got something like 50 billion US or euros. I'm not too sure what it is actually. But they said that the claimants hadn't been very honest. And this is a very Russian case. It's oligarchs who had been given shareholdings in UCOS for very low prices. And it shows anyway the importance of the obligatory arbitration in that energy charter of basically Europe. So let's go on. And I'm going to finalize my presentation a little bit coming into the WTO. The WTO I mentioned was negotiated more or less at the same time as the NAFTA agreement. And it basically has some of the same features. It has the GATS, the services area, and that's probably the ones that has more difficulties together with the the national treatments, the obligations, as I mentioned earlier, are the same. The national treatment, you have most favored nation treatment, and you have the exceptions. And here I think a little bit, and we're going to hear a little bit more, I think, about the details of this. The problem with the GATS and the exceptions is that it came into the negotiations very late. I think this is also an illustration of how these negotiations goes on. They are usually negotiated by foreign affairs, economics divisions, and taxations is not really their strong, area of knowledge. And I think you can see clearly here, if you see the next slide, which is my last slide, the difficulty, and if you go into the details on the exceptions in the GATS, there are footnotes, there are all sorts of interesting sort of interpretations and etc. to make sure that you can still apply withholding taxes basically because of the most favored nation and the national treatment clauses. So I hope I gave you a little overview. It has had to be very short, I'm sorry, but I'm sure we can have a very lively, more interesting discussion when we hear from my colleagues in the panel. So thank you.
Mudo, Betina.
Oi, estou sem
Betina. Now we carry on. Next presentation. Professor Livio. It's an honor having you here discussing aspects of intellectual property and concerning VT. Professor Marcos Livio, it's a pleasure to see you again, even remotely taking the floor. Professor Marcos Livio. Good afternoon, everyone. Dr. Betina, thank you for the presentation. My greeting to the other professors around this virtual table. Professor Gustavo, Professora Betina, Professor Paulo Caliendo, and Pedro, special greetings, and Gustavo, Vettori. So when we are coordinating panels, so even remotely, this theme is so important. We are discussing international taxation, and as Professor Livio has commented, in commercial law, when we discuss treaties that do not involve presentation directly, we do not have to be so familiar with this kind of interpretation. So sometimes the inverse way also occurs. The idea is having a brief presentation and then considering with you a concrete case like seed royalties that can be a good example of how the interaction of tax law with treaties that are not taxation treaties or tax treaties will affect relations that we consider tax relation, contractual relations, and addressing these points for controversy and for discussion, I would say. Now, let's pass to the next page. Okay, what's important in this presentation is the TRIPS, national treatment. It's the protection of intellectual property treaty. So what's the consideration that's relevant in this moment? Just historically speaking, in WTO, it started in 1994 with this, and it is trying to have a role of harmonization in international market and trade, just taking the blocks off, the gurgles off, to advance internationally in terms of trade. In this paradigm, we have a period that's pre-WTO, let us say that and a post-WTO period that is 94 onwards. And so what would be the main paradigm and main operation? If before 94, we had only GATT to regulate issues concerning international market or trade, mainly, specifically, the national treatment concerning trades and trade barriers, specifically for goods, and per se it causes controversies. Until then, we did not have the progress in terms of digitalization, so we changed the paradigm in a way. Generally, the economy is changing from trade and goods to economy of services. And now in the third phase, we have the migration service to digital service. With all this, that we accompanied with WTO, and the impact is very relevant. Besides that, it's also important to consider that from 94 onwards, we had the segregation in 3 basic instruments to regulate GATT specifically, with the future exhibition of that. One, focus on goods, the other services, and specifically the third one, protection of intellectual property. So 3 pillars. Before entering specifically in a device that could, enter in a provision that we could discuss it. What are the objectives, the main objectives when you consider the TRIPS launching that was in Brazil since 2000. So 5 main topics would be how the provisions in general in a multilateral trade system, how does it domestically applies, and the minimum protection, and is it relevant? Yes, because we do the consultation by the revenue related to the protection of the TRIPS concerning intellectual property, and with that it tries to put out the protection of TRIPS per se, was bringing in terms of discrimination, tax discrimination. It will be put into discussion, which are the procedures to provide these rights, how to solve the disputes, and what can we have as special clauses. And the provisions, doing a parallel, and as a parameter to compare that it's before the TRIPS per se. So the Article 3, Part 1, the TRIPS agreement does not specifically say about tax aspects. So following the line of the professor that anticipated my talk, so it's not only the treaty agreements or tax agreements, sorry. In fact, they were not maintained and contained at that time. So we do not have a provision regarding discriminatory taxes as we have in Article 3 of GATS. It takes us to some consideration. The first consideration would be if the TRIPS agreement, this is a relevant point in the discussion, is representing the IP protection, or if it goes faster when you compare to double taxation agreement using a standard as a comparison, Article 24, or the Model Convention to avoid double taxation, where you have the principle of non-discrimination. Going back to TRIPS and closing on it, is it specific for IP, or it is vaster, also comprehending indirect discriminations passed via products that could impede or make difficult the transfer of technology and the exercise of the intellectual property right. So concerning the Brazilian case study, CD royalties. And in this point, it's interesting historically also remember that CD royalties Our tax treatment is hybrid, single, to national, and we also have the possibility of contributions with this mechanism, contribution for intervention in the economy. The points I will point out. It's very interesting to consider the author of this subject. We should consider the RA 49 of 11 September, where we discussed the constitutionality of city royalties. In a national constitutional context, we do not have an answer for that yet. Concerning SIG, it's important to point out that it's not the object of judgment specifically of the TRIPS agreement, but it's a good parameter for us to know that we have concerning the Supreme Court with consequences that will be bigger than they're discussing now. Going back to the slides, specifically SIG, part of the doctrine in Brazil mentions SIG as tax planning well succeeded, the most successful one, because income tax on sending royalties was taxed on 25%, and the remittance of taxes, they were divided or split a portion among the states, and so the rate was 10%. So it left the standard of rate or calculation, statistically speaking, for international treating. The most intelligent tax planning was done by Brazil, reducing the rate from 25 to 15%. So there was a contribution of intervention on the remittance when the national company hires technology where the royalty is paid. So we had the payment of income tax, and we had the payment of the contribution of this royalty, 10% rate. So internally, it was done by the state when it was made in the city and maintain the burden for the taxpayers, but the taxpayer base is maintained, but from the imposition limitation was taken off the contribution or intervention, economically speaking. So revenue considers this. It's classified, even in our law, that SIG is not a tax that is under the umbrella of the street network. So when it refers to resident taxation, etc. So the biggest question here we place for discussion in this panel, and it's food for thought for my colleagues. So question this, could I consider SIG royalty institutional a violation or not of the TRIPS agreement? So Pedro, please carry on with that. The authorities, the tax authorities, have they manifested themselves about it? Yes, with the discretion I mentioned before, in the sense that there is no violation of the TRIPS agreement, because it's limited to the protection of the IP, and so it does not refer or similar to GATS, because a case of non-discrimination concerning taxation, so SIG is excluded here. So Pedro, we can carry on with our slides. And now, just to wrap up, discussion points that we could bear in mind. Effectively, there was any kind of planning from the part of the state, in this case of SIG, should we be just confronting this situation, and could I say that as TRIPS, under a certain scope of TRIPS from a tax perspective, is it a violation, a direct violation in the principle of non-discrimination? Should we admit that SIG is a discrimination indirectly to TRIPS, because in a certain way I am making difficult the transference of technology. So I am offending the principles of the convention. And in fact, does it violate good faith principle? So, and if is it in the under the umbrella of the sovereign possibility to impose taxes, something that could be contrary or not to the TRIPS agreements and others, commercial treaties under GATS. So I close here and I thank you all for the attention, and I'm here for the Q&A.
Eu agradeço a
I
exposição
thank
do Marcos
for
Livio.
your lecture. Thank you very much. Brilliant, on the time, very British, and didactically speaking as well. Now I pass the floor to Professor Paulo, that will talk about the general agreement on tariffs on the trades and the general agreement on trades and services from the point of view of the Brazilian market. So, good afternoon. It's an honor receiving your invitation for this prestigious forum of IBDT. And in this Congress, International Forum, and chair is Professora Betina Magno, and my colleagues around this table, all of them, and also Pedro Schoueri, that is with great help organized this panel. And the theme I'll deal with has been in a certain way introduced by the other professors, by Masco, Professor Matos Filho introduced the subject, and then concerning the national treatment to the subject and the discrimination aspect or anti-discrimination aspect. Please, in the first screen, we have Professor Marcos Livio has commented the GATT article in clause Article 3, national treatment on internal taxation and regulation in the country. This article has a long tradition in the Brazilian records and Supreme Court as well, and there are some aspects that we should comment. The first aspect is there. It applies to countries that are signatories of GATT treaty. So we have some cases referring to countries that were not part of the agreement, Russia before its adhesion to GATT, and also related to fertilizers. So it applies only to the signatories of the agreement. On the other hand, this article places some provisions here that are very important with elements that call our attention. The elements that form this analysis of the national treatment and the case of discrimination. We have the decision of the Appeal Court of WTO about the taxes applicable to drinks, alcohol drinks in Japan. To understand the case, it prohibits discrimination of the origin of the products. That's a theme we'll go back. And also, there is a ceiling on domestic protection, direct or indirect. So these elements are concerning the appliance of the agreement resulted in several cases. The first thing that we have to note that it is the enforcement. And let us say, we cannot have internal taxation or other forms of taxation because in the case the use specifies amount of proposed should not be applied to imported domestic products so as to afford protection to domestic production. So when we consider the Article 155, it's like import tax, not domestic market tax. So when there is merchandise that is imported, there is the taxation on the first circulation. And the first conclusion is that in this case, the ICMS or VAT is not a an importation tax, but it is the sale, the first circulation of the product here in the country. So therefore, in the Supreme Court, that was the understanding concerning the treatment that is given to these products. The wording of the appeal court was that it established, first of all, that we should differentiate similar products to verify if there is the appliance of an internal tax with discrimination effect. This analysis in principle has to be done case by case. We do not have a general rule for that, and the rule requires some understanding, a factic way concerning certain elements. And this rule has to observe certain criteria. There is another judgment from the part of WTO in 96 dealing with a case that was brought via Venezuela to Brazil concerning petrol. And the judgment was and the position from the United States. At that time, there were criteria, minimum criteria. What would be the understanding concerning similar product or characteristics that are replaceable? So another element that is observed is these products, are they directly replaceable? It's not a case on having similarity. You also have to the product in competition directly here. The idea is that if I have a product that we sell it, so you do not sell the similar one, so it's a direct competition. If I sell oranges, so people buy less apples. So this decision is established with three elements that are very important. First, direct competition. The tax cannot be in a non-similar way. And third, the biggest element, this taxing there is discrepancy, but it is only to protect the domestic market. In a certain way, we conclude that, internationally speaking, and also the high courts, the rules of the agreement apply directly, and they establish subjective rights to national products. So Brazilian agreements, they deal about a sector, a system concerning protection. And it's not very clear in Brazil in concerning international agreements. We have Article 98 of CTN. During a long time, the interpretation required interpretation concerning the effects, and partially understood that hierarchy was the motto, and on the other hand, they established that these effects were established via the principle of speciality. So it's been decided, this matter, especially now in the Volvo case, that's recently treated concerning exemption of dividends. After the High Court's awarding, we have a solution of a very important case that was established, and with some rules for the international treaties, and it consolidates the idea of direct effect. So, Brazilian courts and the application of trade treaties. Products If the treatment is similar to the national ones, we have two positions concerning the different positions. One, the states detain the autonomy, and others that they do not detain the possibility of maintaining agreement with the idea that will be an heteronomous exemption. But in a certain way, it has been consolidated the idea that when we establish the foundation of the international trades, it works like an national entity representing the nation, not a federal body. So there is the possibility of maintaining this decision to avoid any possibility of sanctions, international sanctions, or other positions that are similar. Now, a set of points that we could debate concerning this subject and the interpretation, treaty interpretation on Brazilian jurisprudence. So I pass them to my colleagues. First point, we have a very recent case in the High Court, RE number 1095, section 97, that was awarded on 22nd of May this year, dealing with an issue regarding difference of treatment to import vehicles via a different rate concerning IPI, that's product taxation. So this decision has a precedent situation. It's very interesting. It's not a protection for the product that's international, but it adds a very important element, the differentiation of the use of the IPI here in these two types of national and imported cars. It is an increment in our importation schedule. If you consider protection to the development, nationally speaking, so it establishes a new accession to the quality. So it applies to all the products isonomy here, and since the 60s, since 700 links, so there is a new exception here. The exception is a quota of presence in the Senate screens. That would be the idea that the national development would be a way to justify the alteration of rates. This matter did not have a high discussion, an immediate discussion, because despite considering this principle that is received in isonomy, in the Brazilian law, it involves economic aspects that is not appreciated under the Supreme Court marks because it is a different subject. Now, the last point to discuss concerning the concept of merchandise. Till now, we had a discussion about goods restricted according to GATS, and in our very clear cases like cod and swordfish operated in Brazil, fertilizers, and other products as well. But it's a discussion that is in the Supreme Court in the 1944 law, and it discusses the goods that can be of different digital, and the digital good should be only taxed by SMS, that is circulation of merchandise. So in this case, it's also a digital good. So it surpasses the classical tradition of the concept between taxation of merchandises with software on shelves and rendering of services that is available to be customized. With that, I close my talk, and we see that all these possibilities, the first one about development or increasing of the national development merchandises that will have a special treatment according to GATS and other treaties. So thank you very much, and I'll wait for your comments.
Thank you, Paulo, for the fond words and the fantastic lecture. Now we go to passing the floor to Professor Gustavo Vettori. And he will start now. Thank you very much. Thank you very much, Professor Betina. I congratulate the members of this panel and thank the invitation to be part of this Congress that is already a huge success. Well, I'm going to talk about the ASCM and its scope and enforcement for tax subjects for direct and indirect taxes. If that the language is not clear regarding its use for direct taxes, but it is applicable when you have a discrimination, either domestic or international, that's applied to products, but then through direct products like some limits imposed to imported products compared to domestic products. So this would be a tariff area, but we didn't get, but we have rulings like Brazil and Argentina that the panel board, although it was not made an appeal to, there's a traditionalist point of view that GATS is not applied to direct taxes. Unfortunately, we will address this later on. GATS, it's applicable, but it's not also because several exception, Article 16 for domestic treatment applicable in enforcement for direct taxes, is more favorable regarding many aspects and also excluded. Subside agreement has its own language for the enforcement of direct taxes, and this is an important point for us to address. So it's a vocation more creative, of course, getting what it subsides or grants. So we'll talk about a bit about this agreement and its reach regarding tax issues. First, understanding it's that subside agreements, we have two type of grants, so actionable yellow, prohibited red. Actionable subsides to have a panel today by these other member states can address the subside that was granted. This subside has to go through specificity test and be approved and prove a damage or adverse effects over the international trade of that country in order that it can truly action the subside. And the truth is that, yeah, those subsides are very difficult to be debated, and these are different panels to be take to the World Trade Organization. It's political wise, and it's easier to go to a damping panel because, in fact, the evidence is not an easy thing. On the other hand, we have prohibited subsides. For these, the agreement removes the need for specific test because it's assumed and damage is abstract. Then, therefore, these are subsides that are earmarked specifically to exports. So in the language of treatment, it's contingency, subsides contingent. So I will grant one for a certain individual because it exports, or subsides I give to a taxpayer with a condition to use domestic products instead or in lieu of imported products. Therefore, both cases A and B have a prohibited subside. I don't need to show that specific and so forth. So here it's our hot topic regarding subsides. What is set forth by this agreement and definition of subsidy? There's a whole wording about it. Basically, what is interest now, according to this panel, there's a definition in Article 1.1, financial contribution that can be understood in item 1.2 as a government revenue that is otherwise due, is not foregone or not collected. Example, tax incentives or tax credits, so forth. The other definitions is not important now. But this was the main point. So it's a government revenue, not taxable, due, but it's not collected. So this is a subside and given by a government or public agency within the territory and then grant benefits. This is the path we have to follow to know if it's a subside. And then looking for the definition 1.2, we fall within the issue related what the revenue due but not foregone. So this is an assumption. I have a baseline, normative baseline, what is a tax system without subside, and then I see subside as a picture for this certain taxpayer. I will not collect taxes. Nothing that's not familiar for us. With several exemptions and so forth. It's not something that's not familiar in our budget, in our inland revenue, to normally to do the demonstration of tax expenditures where it comes all this issue. And I don't need to know how a system without system. So know the system without incentives and then calculate the impact of. We have this debate for 100 years, and academically wise, it's very difficult for purpose of financial rights to put the division line, the definition of what normative baseline and see what the subside. There's a level of of subside. It's subjective. How empty, how full glass of water. So the system should be like this, and it's like this. So there's a cut, and this cut represents subside. So all the difficulty to identify a subside through tax rule within the World Trade Organization, this was complete for budget. Now for international trade system, this concept will set forth and determine if a country will have the right for a compensatory measure or not. See its impact. All this difficulty we find and panels of the World Trade Organization, this normative baseline is not abstract. It's not ideal tax system. No, you're going to look normative baseline of the country, what is done normally, and then identify if there's an exception for exporters. And this exception will be taken into account as a subside. So we must find the baseline within the tax system of each state member, and this does not mean the starting point of each one of these member states can determine if this will be considered subside or not. And here resides a debate, and it becomes hot topic. So this was defined, but for best from the but for test. I'm sorry, but for test. But for test, and we lost the sound revenue that would be collected otherwise due, but not measured in question. I don't know what happened. We are without sound here. So this idea of baseline, normative baseline for the World Trade Organization and third article of GATT and the subside agreement, its attachments, the enforcement of what they call border tax adjustments that we call destination principle is not considered a new import network, as was said, and the exemption, immunity, name as you wish, but not taxing imports is not considered subside to import when I'm talking about indirect taxes defined by the agreement and levied on products. So if I had a tax levied over products in-house, domestically, and in domestic imported products, the similar products will be taxes levied on the same form, the same way, the same rate. So it's not a tariff. So it will only be if it's in balance, different. Likewise, if I have a tax and over levied over products domestic, when it is exported, this tax will not be levied. And furthermore, all the residue of taxes in the chain that was levied on previous stages, this is not a subside to exports because indirect taxes follow the idea of the principle of destiny. On the other hand, when we analyze direct taxes, we don't have this rule. For direct taxes, the assumption is that of the WTO property taxes and income, so forth. If you have this tax on exporters, you see a subside for exports. In income tax matter also, if you find some adjustment of income tax in imported products, this will be a barrier, not tariffs prevented from Article 3 from GATT. The clear differentiation is there, direct and indirect taxes, it's clear. So attachment 1 of the subside agreement sets forth a list of types of export subsides, and it makes it clear you granting direct benefits, including income tax for exporters, it's a subside to exports. Why do I make the differentiation? Because it leads to a point. Those countries that collections focus on income tax, like USA, historically wise, and by exporting taxes, source taxes, and you cannot offset that on the WTO. Those countries earmark it to VAT, they have border adjustment and does not impact international trade. There's a war between USA and Europe due to the trade because different options of tax mix between both, historically wise. And this with this, we reach some cases. So we have taxes on indirect subsides. If you give something more than the payback to exporters as a subside, if you give any incentive indirect taxes domestically conditioned to national products compared to imported, it's a subside. It's what happened in both cases of Brazil dispute settlement 497 with European Union and several other rules of PIS/COFINS taxes levied here in Brazil that condition the use of tax benefits to the use of domestic products compared to imported, and Brazil lost all. They were deemed as a breach of Article 3 of GATT, surveillance to print, and also to the subside agreement because, in fact, it had the requirement to be a domestic product to get the subside. On the other hand, direct taxes. The most important cases are American disputes, European Union against United States, and United States before the WTO where there was a region that American companies earmarked for exports, and basically USA said they would not tax the income of these companies. European Union said this is subside to exports. And USA said, European Union, you have a source rule whereupon the revenues of exporters is not also included in income tax. So there's the panel, and panel basically said this violated and source rules limited to European Union, limited, but before WTO, there was no appeal body and direct effect on the results. And so USA revoked this rule, and basically it's a sub abroad of American companies, and its profit was not taxable in USA as long the sub company was earmarked to exports, bought American products and resold it. Interesting to say, other subsidiaries that were not like this, they were taxed on USA, and USA said this is not subsidy, they're just doing what the Europeans do. It's a territory regime or system. Made no distinctions. So in no importance. And then a panel said no. If you choose to tax the controlled company profit abroad, you cannot do it just to exports. You have to tax all ununderstood as subsides, and this was one of the biggest offsetting measures of history. Interesting the conclusion of this case that it's not that talk. It only worked as systematic of these corporations, CFC corporations, because they did not apply that well the transfer pricing rules, only when it was sold to controlled companies abroad. So this the issue is deal with in an ancillary way. But the footnote 59 that the states recognize that in an exports you have to have transfer pricing, otherwise you grant a subside to exports. And finally, just to wrap up, currently with the reform by Trump for American income tax, it seems that the issue came back. When we look the FDII, foreign derived intangible income rule, it's said as it's a rule to attract intellectual property into the USA, but in fact, it's an export tax incentive because instead of being levied 20% when you export, it's just 13.1 to 25%. Back to the debate, it's almost an a disc, but the biggest question is someone interested in this now, post-Trump era, where the appeal court is with no indication of appointment of new members, and it seems that for the purpose of WTO, they are not that concerned if this will be against or not the system of international trade. And after the debates, we will present new developments and how can this affect Brazil. Thank you very much for your attention. Gustavo, thank you very much for your words. I think your brilliant presentation. I pass the floor to the word to Pedro, Professor Pedro Schoueri, to be moderator of the works of the second part of our panel.
Thank you, Professor Betina. Thank you all the panelists for the brilliant talks. And I understand that the theme is passionate and complex, and it's tough to do an overview very quickly, but I think it was clear to us. I would like to pinpoint the biggest message that is passed on to the debates. We have a system that is an international trade system that we try to put barriers down regarding trade, promoting competition. On the other hand, we have measures, taxation measures that we have to follow. And then there is a conflict that is very clear. I have to observe the treaty as far as what are the exceptions in terms of trade treatments. So, of course, that is in the debate, non-discrimination clause, subside clauses, and etc. Considering this context, we considered two big questions bringing and brought to you to the present discussion that we're having in terms of international affairs. One, the blacklists. How long can I go using that or not? Second, digital service setting. It is an alternative that is being considered and discussed. Digital economy, what would be the problems regarding the trade, international trade in this, observing this treaty. Just to start, before passing the floor to others in the debate, concerning the blacklists, in the case of Argentina, financial service, that's the F4, the decision of 2015, and the body of controversy solutions. So without entering into details, Argentina has listed Paraná because they were not fulfilling the agreement in a normal global way, would say it was legitimate. So there was a contest of promoting the exchange of information as Paraná did not fulfill. And so Argentina listed, consequently, some measures in defense. Let's say retaining at source, higher transactions, withholding taxes highly. You see, and rigid, restricted deduction, and with Panama, all the transactions were considered as with the complications in terms of transfer pricing. And considering it was not taxation nature, but for us it was interesting to observe the result of this controversy. It was decided that the treatment was less favorable, or what's happening here, just an attempt to bring back the conditions of equality for the, let us say, level to the same field. So it would be a dispute resolution body deciding that. So is it discrimination involved in the context of international trade? One of the discussions that I consider very interesting in the panel, the panel did not have a conclusion because Panama did not prove that the services they were presenting were equivalent to the Argentinian aspect. It's a very complicated thing to place an evidence if there is equivalence or not from one jurisdiction to the other. But there is a consideration of the Global Forum work. This context of the international taxation can be incorporated in the treaties of international trade, i.e., just introducing this case, we have to observe that we have 20 minutes, so please be brief as much as possible, and Professor will make the Betina will make the consideration. Sorry, Professor Liselott Kana.
Yeah.
Professor Liselott Kana.
Thank you, Professor Betina, and thank you, Pedro, for the introduction. I think the case is extremely complex, and I don't think we have any time to go into the details. But what happened? What the result was that Argentina's blacklist was basically proven to be against GATT's rules. And in that sense, what happened afterwards? And that's where I want to be a little bit controversial, but I think we need to be controversial today. And I have had words with my Argentinian colleagues, and I can't see very much that Argentina did anything. So my problem today is a little bit, and that's what I want to raise in this meeting, is how are these things going to be implemented? Are they just going to be an arbitration, and we're going to have a rule, but no one is really going to do very much about it? And I wanted to add to that, we are now, and the next issue that's going to be talked about is digital economy. One of the things that we're going to have in digital economy is mandatory arbitration on Pillar 1. That's what we've been told is what the US is interested in. And unless we have US on board, this is also what we've been told, we won't have very much to agree on in digital economy. So when you come to mandatory arbitration, you come to the WTO, and you realize that out of the 100+ members of the WTO, the only country who has actually today vetoed the arbitration tribunal is the US. We don't have an effective arbitration tribunal today at the WTO because, and I don't know the intricate rules of WTO, but the thing is they have to appoint judges, arbitration judges. And because they have a time period, the actual time period has run out of the actual arbitrators. And because there is one country who says we're not going to nominate a new judge, we actually are stuck without a WTO arbitration tribunal today. So all these things, in the end of the day, I want to be controversial. And I said, is really, to me, making it a little bit difficult to work in the international area because the little arbitration we had is breaking down as well. Thank you.
Thank you, Liselott. Gustavo, desculpa. Obrigado, Liselott. Gustavo, se você tiver algum outro comentário a respeito também.
Só alguns comentários sobre blacklisting em Pillar 2.
About blacklist, sorry. I'll be very brief. Brazil, beside Argentina, we have many rules concerning blacklists, and I believe, like the case Argentina-Paraná, we could take, yes, for instance, limitation of activity concerning transparency, tax transparency. We have rules concerning transfer of price despite any binding, and we have rules with surplus, and it is also, besides that, another one, withholding at source when you remit to tax haven. And concerning Panama, Argentina, measures concerning income tax can be taken according to GATT, and I think that it is the decision. It's not an appeal here. It's something that will be taken if we still have appeal agencies. So I believe that transfer price concerning product, we have discrimination, yes. And Article 3 is involved here. In the rest, we can take via GATS and let's say members of national treatment for several cases, but in nations that are more favored, the national treatment concerning GATT, it's positive. So the sector there concerning rights, it's okay. But those that are more favored in terms of nation, you have to consider that. In the case increase of 15 to 20% when it's the technology service, it's discrimination. Royalties and interest, it is more module 3 of action. It's an impediment for other countries that would not have outside the blacklist, like the Panama and Malta, they are members of the WTO, and it would bring a case like that. Obviously, we have a test of similarity that has to be faced. And it's interesting to note when you consider the negative list, the exclusions, and attachment to the less favored in GATS, the United States had lots of exceptions in direct treats. No, in Brazil, there is no exception for the direct treatment. The only way would be the Article 16 of GATS, that is to implement the rules, etc., to make them in force. But I think that Article 16 in GATS, it does not place this arbitrary discrimination because that country in a tax haven can do anything. That's not the case in Argentina. I think there is a possibility. Concerning the Pillar 2, I think that it's the same sense, same path, because you have two rules there that can be in conflict with the trade rules. One is limitation of legitimacy, and the other one taxation of the company abroad, the sub-company abroad, with the limitation of possibility, i.e. income tax on countries with low taxation. In this case, we have an argument of GATT that is weaker with limitations, but we have an argument that is strong with GATT, with more favorable nation, to consider the limitation concerning legitimacy and withholding at source, and also the taxation on sub-companies. So I have a sub-company being taxed and they are in a blacklist in favorable jurisdiction. I think that we can say it is according to aspect Article 3. Again, we are entering a discussion of the Article 3 of GATS and less favored nations. There is a clause that is expressed in GATS when you have measures that are with the litigation discussion. So in this case, if there is a multilateral agreement, maybe we put off the use of GATT because it's a tax agreement and there is space for that. I go to 016. Those that wrote these things at GATS, it's not taxation team. I talked to people there. It is just a last moment call. They did not know exactly what to do concerning direct resources, and they phoned taxation, said, okay, let's do it. So this wording is the wording that will say if it's good or bad in the system. Of course, there is an agreement to implement the GATS. So you see the collision in terms of words and different words that we have here. Thank you. I agree with you that the problem is big, Gustavo, concerning tax treaty. You have the tax treaty and you have to observe what GATS has. And of course, it takes the pressure from Pillar 2. But we have another reasons to observe that the European Union has its own blacklist. And the objective mentioned is exactly doing trade with countries, and we cannot have discrimination here. My interpretation is that the action will not pass by these international rules, trade rules, because of this case, lack of a panel that is focused on this discrimination. Briefly, because we don't have much time, have a second discussion that's very important concerning international trade regarding the digital centers. How can we have measures for the digital economy with the discrimination aspect? Professor Marcos Livio talk about it. Marcos Livio. So following the points that have already raised here for discussion, I like the theme. I have lectured with my students in PhD about this subject, and it brings many things to observe, making this distinction between direct and an indirect tax. And when we deal with digitalization and taxes, we have an abyss of doubts concerning the legal aspects. Are we talking about digital assets? What's the classification, legally speaking, importation of softwares, license to use softwares, how the structures concerning taxation, how do we solve the problem? Of course, we have more doubts than answers. First, I could pinpoint what's the legal nature of imported assets or goods. Are they digital goods or digital assets? Uh, does it involve software transfer? And if I have goods and services and softwares negotiated, and how do we deal with it? And in fact, if they are important, it's an international discussion. So how can we conclude this specific action concerning BEPS project? And OECD is facing a big dilemma in what will be the scope of the sharing or redivision. Internationally speaking, European Union has already affirmed if there is not a decision of OECD, they will implement the digital service tax. And so they affirmed that France, in UK, other countries, Israel, and it takes us to a discussion from the point of view of a Brazilian perspective. Let us say three solutions, legislative solutions that are being analyzed, very important, very relevant, and in line with what is being discussed when we have first the Bill 131 of 2000 and the 139 of 2020. So there is an article in, and it's established the digital tax. And so also the subject refers to digital platforms. And I have the star of the times via the launching of discussions about goods and services as a project of 2020. And it will replace PIS and COFINS tax with another tax. Parou. 2020 will have similar processes that we call this
digital services tax. Is this all right, or certainly juridically wise, or this is the concept of scopes of treaties that deal with direct taxation? And it is right that the legal nature is uncertain in terms of direct tax and direct tax. Is it what is it in fact? What's its nature? And finally, what can we launch in terms of doubt or food for thought, reflection, if these initiatives are being debated worldwide and reflect in domestically in Brazil, if they violate the TIPS, submitting one of my final remarks, it seems to me that the non-discrimination principle of the treaty is more encompassing than the non-discrimination agreement, Article 25 of the OECD. In a way, according to my perception, it could absorb a indirect violation, and this in a way could violate the treaty because it would be through a tax, non-incentivized technology transfer. This is a point I would like to address. The second is the issue related to if as a legal nature, TST will be related in which way with GATS and TIPS, and what its legal nature in a way, in which way can we assess this as a tax that violate non-tax treaties. I thank your intervention by Pedro, Professor Betina, Liselott. Thank you very much, Gustavo. Thank you, Professor. Now we are reaching the end of our time. I would like to open for Professor Paulo. Do you want to say something? 1 or 2 minutes, Professor Paulo? Briefly, just to add, thank you very much, Pedro. Professor Matos Filho mentioned things I would like just to. Marcos Livio, I'm sorry. This subject, it has a huge impact, especially because USA opened investigation through State Department regarding several countries, including also digital projects by Brazil. As for France, USA enforced measures of retaliation, and France backed with the lifting of collection due to international agreements. And these agreements, in fact, the tax proposal for digital services will open debate internationally, wise with TRIPS and bilateral agreements, and issues that we already checked previously, in addition to those issues that are conditioning circumstances. If you see the bill of 020, it sets for taxation for big companies of technology that invoice more than 3 billions. We want to know up to when this is allowed in Brazil, in the sense redistribution or creating unfavorable treatment for big national tech companies and foreign tech companies. Also, the principle of everybody is equal according to the law would be affected, and the proposal that the appeal collected resources collected by CDGNAL would be for tech developments, which is a fund that it's not fulfilled by Brazil. We have studies. It does not invest resources to this fund, no transparency over values. And to wrap up, to comment that, therefore, these measures can generate international controversies. Again, the idea that we are not discriminating products and services, but discriminating products and services that increment national development should be admitted as exceptions by the STF, and therefore the ruling by the STF, it's very dangerous regarding new possibility of discrimination that would be. Thank you, very Professor Schoueri, and all the panelists, and Marcos Livio. So, Pedro, I think now you wrap up, I wrap up. Who would? I would like just to thank the debate because, in fact, it was so profitable and we fulfills the function of shedding light in this subject, which has a concrete impact when we talk about international trade. So interesting, I think debates fulfill this objective of shedding light in on the subject and put this white elephant in the room. Thank you very much. So, last words, thank you very much. The brilliant comments, excellent panel, enriching, and it was enriching everything that we talked, and the opportunity Professor Luis Eduardo Schoueri coordinated this event fully online. Thank you very much all, and have a lovely afternoon. Thank you.